Why is Warren Buffett holding so much cash? And what is his next big bet after recently exiting his S&P 500 index fund positions? Hello, members, super savers, and bond course fans. I hope you're healthy and well. It appears that many of you in our community have some top-of-mind questions about Warren Buffett and why Berkshire Hathaway, the company that Buffett chairs, recently sold all of its S&P 500 index fund positions. That's what I discovered on our live member Q&A last weekend. Here's a short snippet of the Buffett and Berkshire conversations that took place in the chat. From one member, speaking of dry powder, do you have any thoughts on why Warren Buffett has such a huge percentage of money in cash? And from another member, thoughts on why BRKB, meaning Berkshire Hathaway, just dumped S&P 500 fund investments. A small percentage of his portfolio, so why the effort to get out of it, I guess? And this one here, anything in particular you took away from Warren Buffett's latest letter to investors as relates to bond investing or other? So, it seems that even though Buffett may have slipped to number 6 on the list of the richest people on the planet, the Sage of Omaha remains a living legend whose every move in the markets is followed closely by many investors. In fact, Berkshire Hathaway's annual shareholder meeting, often referred to as the Woodstock for capitalists, is expected to attract as many as 40,000 investors again in 2025. Some of you have already told me you're planning on going again this year. No surprise then that Buffett has been all over the news the past week and a half after he released his annual letter to shareholders, followed by Berkshire's annual report. As I told our members last Sunday, we hadn't read Buffett's annual letter to shareholders at that point, so I could only give some general thoughts on why he might have sold all of Berkshire's S&P 500 index fund positions and what his plans could be going forward with his cash pile. Well, we have since read the letter, so with that in mind, here are the 3 topics that we'll be covering in today's video. 1. How did the last year go for Buffett and Berkshire Hathaway? 2. How is Buffett positioning his investments for 2025? Understanding the answers to these first 2 questions will bring us to 3. What else does Buffett want to tell us about his next money moves? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. How did the last year go for Buffett and Berkshire Hathaway? For 2024, Berkshire Hathaway reported underlying operating earnings of $47.4 billion, up 27% versus the previous year. Operating earnings is essentially the after-tax profit from Berkshire's business activities, excluding any gains and losses from its financial investments. Overall net earnings, which does include, among other things, the gains and losses from its financial investments, such as on the stocks and bonds that Berkshire owns. Overall net earnings came in at $89.6 billion. And while this was 8% lower than the previous year, the market still liked what it saw, as Berkshire's results actually exceeded expectations, pushing its stocks to new all-time highs. And yes, I said stocks with a plural S, because for those of you who may not be familiar with Berkshire, there are 2 share classes outstanding. The first share class is BRKA, the original Class A stock of Berkshire Hathaway. BRKA initially climbed to an all-time high of a whopping $759,923.94 per share. And the second share class is BRKB, which was introduced later to make investments in Berkshire more accessible to individual retail investors like you and me. BRKB initially spiked intraday at a new all-time high of $513.02 per share before falling back a bit again. So, let's have a deeper look now at the 2 main sources of Berkshire's reported overall profits. The first source, the operating income of $47.4 billion, is the after-tax profit from the 70-plus companies in 4 segments that Berkshire Hathaway fully owns or at least controls with an 80% or higher stake. Insurance, including Geico, yes, the one with the gecko. Railroad and utilities, including BNSF, Burlington Northern Santa Fe, a major U.S. railroad. and the Berkshire Hathaway Energy Company. Manufacturing, including battery maker Duracell and clothing brand Fruit of the Loom. Service and retailing, including fast food chain Dairy Queen and NetJets, a provider of timeshares for corporate and private airplanes. The second source of Berkshire's reported overall profits, the remaining $42.1 billion, to get to the full $89.6 billion in net earnings for Berkshire overall, comes mostly from gains and losses on the financial investments that the company owns. At the end of last year, Berkshire has short-term investments in U.S. Treasury bills valued at $286.5 billion. And fun fact, like many of our Diamond NestEgg regulars, Buffett was very happy with his Treasury holdings last year and kept adding to the position. In Buffett's words, in 2024, Berkshire did better than I expected, though 53% of our 189 operating businesses reported a decline in earnings. We were aided by a predictable large gain in investment income as Treasury bill yields improved, and we substantially increased our holdings in these highly liquid short-term securities. Berkshire also had investments in fixed maturity securities valued at a relatively modest $15.4 billion. These are bonds that are not already included under the short-term investments in U.S. Treasury bills here. In addition, Berkshire had investments in publicly traded equity securities valued at $271.6 billion. More on this shortly. So, congratulations to our Diamond NestEgg regulars who own Berkshire Hathaway stock. And if this is you, drop us a comment below. What's your experience been with it so far? And do you plan on keeping your shares? Or will you be selling some anytime soon? Because remember, while Berkshire's stock price has developed quite nicely, to tap into your Berkshire gains, you will need to sell your shares because the company doesn't pay any dividends, as a matter of principle. But more on this later as well. Buffett has indeed proven his investment prowess once again in 2024. But what we all really want to know at this point is what can we learn from him for the future, which is a great segue into the next section of today's video. How is Buffett positioning his investments for 2025? Unlike in some of his previous letters, Buffett doesn't say much directly about where he expects the market to go in 2025 and beyond. So investors have been trying to interpret some individual facts and side remarks to deduce whether Buffett's outlook is more pessimistic or optimistic. Here are 3 observations that stood out to us, which some of you in our community may also find interesting. Observation 1. Berkshire Hathaway's cash holdings, defined as cash, cash equivalents, and short-term investments in U.S. Treasury bills, have basically doubled to $331 billion from $166 billion a year ago. Many observers have interpreted this as Buffett being as bearish as he ever gets, and think this is a potential sign of trouble to come in the markets. Now, Buffett himself has gone through some pains to explain this large cash position in Berkshire's shareholder letter. Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities. That preference won't change. Which brings us nicely to our second point. As many have noticed, Buffett has significantly reduced his public equity holdings by 23% year over year. Here again, Buffett himself cautions folks not to overinterpret his positioning. While our ownership in marketable equities moved downward last year from $354 billion to $272 billion, the value of our non-quoted controlled equities increased somewhat and remains far greater than the value of the marketable portfolio. Non-quoted controlled equity refers to Berkshire's private equity holdings in the form of the operating companies he owns at more than 80%. And as we all know, it's much harder for Buffett to reduce his exposure to private equity, even if he wanted to, as he would essentially have to sell these companies, which is much harder than just putting some shares on the market. That said, the reduction in Berkshire's public equity holdings does seem to indicate that Buffett, to a certain degree, has grown skeptical of where public markets will go this year, and may be positioning himself a bit more conservatively or even defensively, as he has sometimes done in the past, and often successfully so. Which leads nicely into our third observation, which fits with Berkshire's overall theme of caution and conservative investing. While Berkshire still holds a significant portfolio in publicly traded shares, as we just discussed, its portfolio is still as conservative as ever. There are only 3 tech names among Berkshire's holdings larger than $500 million. And apart from Apple, you can even have a long discussion of how tech, Amazon with its warehouses and delivery drivers, and T-Mobile as a wireless carrier really are. It appears that Buffett has maintained his cool distance from the more household tech names that have driven various indices to all-time highs in recent months, such as Nvidia, Google, Meta, and so on, which also ties nicely back to these live member Q&A questions from last weekend about why Berkshire exited its 2 S&P 500 index fund positions, specifically VOO from Vanguard and SPY from State Street. Do keep in mind, though, that each of the funds was valued at about $40 million when Buffett sold them, which is really just small change for Berkshire. Both funds, when combined, accounted for no more than 0.02% of the total investment volume. That's essentially like an investor with a $100,000 portfolio selling $20 of their S&P 500 index fund position, or someone with a $1 million portfolio selling $200 of their S&P 500 index fund position. So I wouldn't necessarily read too much into this move. It could just have been a portfolio cleanup at year end, which is not atypical in the industry. That said, and in light of the 3 observations we just shared, the doubling in Berkshire's cash position, the significant reduction in Berkshire's public equity holdings, and Buffett's general lack of affinity towards pure-play tech companies, as well as this statement from Berkshire's shareholder letter. Berkshire will never prefer ownership of cash-equivalent assets over the ownership of good businesses, whether controlled or only partially owned, with the key words here being ownership of good businesses. So, in light of all this, it does sound like Buffett can't find good enough buying opportunities right now, and is proceeding with caution in the market overall, in particular with the S&P 500, which has become very tech-heavy and somewhat expensive in the eyes of more conservative and or traditional investors. Or perhaps Buffett sees signs of a slowdown in specific industries that could have implications for the broader economy. Remember, he did state that 53% of Berkshire's 189 operating businesses reported a decline in earnings last year. And let us not forget the job cuts that are happening now in both the private and public sectors, and the uncertainty around tariffs. The shrewd investor that Buffett is, he may be positioning himself a bit more conservatively or even defensively, as he has done in the past, especially since Berkshire seems to be perfectly content with the yields that it's getting on its cash. In other words, there's a fair bit of reward for doing nothing, just letting the dry powder sit there in T-bills at not unattractive rates. So why take the risk of buying something that might be overvalued right now? Which brings us nicely to the next section of today's video. What else does Buffett want to tell us about his next money moves? As he does in most of his shareholder letters, Warren Buffett also speaks about topics that are not necessarily directly related to the performance of Berkshire Hathaway in 2024, but are best understood as general investment and financial advice from a master in the field. And I get the feeling he loves this lecturing quite a bit, as it does take up some space in the letter. This year, Buffett brings up 3 main points. First, Berkshire Hathaway has only ever paid a dividend once, in 1967, and Buffett sees continuing reinvesting and compounding over 60 years as one of the secrets of his and the firm's success. 2. Berkshire Hathaway has been sending eye-watering amounts of money to the IRS. Berkshire paid far more in corporate income tax than the U.S. government had ever received from any company, even the American tech titans that commanded market values in the trillions. To be precise, Berkshire last year made 4 payments to the IRS that totaled $26.8 billion. That's about 5% of what all of corporate America paid. As Buffett reminds us, smart investors don't minimize taxes. They maximize their own returns, even if that means paying hefty taxes on the reinvestment, as long as that leaves them better off than minimizing taxes at the expense of their own long-term return and profits. And 3, Buffett remains bullish on America, a theme that has been constant throughout the years. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. And he continues, however, as Charlie and I have always acknowledged, Berkshire would not have achieved its results in any locale except America. And as our Diamond NestEgg regulars know, we're of the same mindset here on this channel. Never bet against America. Of course, when the right opportunity comes, even Warren Buffett isn't averse to a bit of international diversification. From Buffett, a small but important exception to our US-based focus is our growing investment in Japan. It's been almost 6 years since Berkshire began purchasing shares in 5 Japanese companies that very successfully operate in a manner somewhat similar to Berkshire itself. The 5 are, alphabetically, Itochu, Marubeni, Mitsubishi, Mitsu, and Sumitomo. And maybe not surprisingly, the shares of the 5 Japanese trading houses promptly climbed after the publication of the letter. So yes, Buffett can move markets. But what might Buffett's next big move be? Well, there are at least 2 ways this could play out. First, if Treasury yields stay roughly where they are, and markets as well, or if markets go even higher, Buffett could simply just keep sitting on Berkshire's cash pile and watch it grow. Remember, Buffett needs to find a good business to buy that will generate Berkshire-worthy returns for its investors. And until that happens, it seems the risk of doing something may outweigh the risk of simply doing nothing and collecting the interest on T-bills. The second scenario would be if Treasury yields come down and or stock markets come down, which would likely happen if there was an economic slowdown, or worst case, a recession. In this instance, Buffett would probably use his mountain of cash to pick up an American company or 2 where he sees value. And this might well be another financial, energy, or consumer products firm, as he seems to like and understand these sectors the best. Let's make this a little fun. Which company do you think Buffett should buy next for Berkshire? Drop a comment below and let everyone know. So here's the thing. As I told our members last weekend, Buffett's portfolio is not our personal portfolio, unless we own shares in Berkshire Hathaway. Yes, it's nice to know what's happening around us, and to try to figure out the thinking behind Buffett's investment decisions. But the reality is that by the time Buffett's next money move is made public and on the SEC site or on YouTube, he already moved markets so much that the average retail investor is unlikely to benefit much from following in his footsteps. As for us, we also have a fair bit of dry powder parked in T-bills at the moment, like Buffett and Berkshire, and in money market funds as well. But unlike Buffett and Berkshire, we continue to dollar cost average into the S&P 500 index and other funds with our longer-term retirement savings. As the old saying goes, it's not about timing the market, but about time in the market. Just think about it. Berkshire has held shares in American Express for about 3 decades and still owns the 400 million shares of Coca-Cola that were purchased between 1988 and 1994. And no, I'm not saying that you should go out and buy these shares. If you really want to invest like Buffett, the best and easiest way to do this is probably to buy shares of Berkshire Hathaway directly. That way, you're not trying to mirror an investment decision that was made weeks or even months ago and that may no longer be relevant based on existing market conditions. So, what are you doing with your money? T-bills, S&P 500, or a mixture of these, or something else altogether? Drop a comment below and let me and the community know. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing while yields are still attractive, then check out this video here on our bond courses. Or if you're interested in learning more about real estate investment trusts, REITs, come join our member zone and check out our latest member videos on REIT investing. This one here was just posted a few days ago. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.